why not, bring an alternative financial product? I find that the biggest issue is capital market dislocation, especially with family offices, right? So, most family offices require a return of 18%. That's a hell of a lot more than a 10% on NSBA. What do you, I mean, so that would be my first, like, to actually give it some like high level thought. Now, I'm not suggesting for 1 second that can't be solved, but it's going to require a lot of acrobatics, and that's fine. That's what we do, right? But this is a more, like as Shane said, there is a built-in mechanism here that we feel confident to kind of roll into and step into the shoes of an existing deal that has a track record, and that's where our desire to want to improve the market lies at the moment.
Welcome back to Lords of Lending, where capital isn't just money, it's power, it's legacy, and it's the weapon entrepreneurs use to build their kingdoms. So I'm Shane, the alchemist. I'm here with Stephanie and Brian. Stephanie, the oracle, Brian, the magistrate. And today we're joined by someone who is rewriting the rule book of Main Street finance as it exists today. So if we're the Lords of Lending, then today we're welcoming, let's call him the Lord of Seller Debt. A man who is bringing liquidity, legitimacy, and leverage to one of the most overlooked weapons in the acquisition arsenal, which is the seller note. So think of him as kind of like a Renaissance banker stepping onto the battlefield with a brand new playbook for business buyers and for business sellers. So with us today is Abby Shemesh. He's the head of acquisitions at Seller Edge Capital. And together we're about to explore how turning seller notes into a liquid marketplace could unlock billions in deals and reshape the future of Main Street M&A. All right, Brian, Steph, we're jumping into this topic today to identify pain points that exist in the market with sellers and buyers. And tell me a little bit about what your thoughts are on why this is imperative before we kind of get into really letting Abby unleash on us.
Um, First and foremost, my initial reaction is, why didn't I think of this? Yeah, because it is genius. And I think that we need to think outside the box. Typical or traditional financing from, let's call it the 40s and 50s, is the SBA program that we deal with today, right? And it is not one size fit all. It does not fit all. And there are a lot of circumstances, quite frankly, still in today's market because of valuations and appraised values, that there is a gap. So the gap ends up killing the deal. And I think that a lot more people now are entertaining seller financing just because they need to get to that final amount. And we can't get there. And no one has these big nest eggs of cash laying around for traditional loan to work. So seller financing is pretty genius. I think that there's huge opportunity. I would love to just uncover ways that we could maybe layer together. I'm not quite sure how that works now yet, but I think that will be something that we probably venture into over the next 12 to 24 months.
Yeah. And from my perspective, I'm thinking of a lot of borrowers that I've come across who, like Steph just said, either can't qualify or you have an operator, a manager of a business who wants to buy the business, but doesn't quite have the capital to do so. A seller note would be a perfect option, but then the seller's kind of reticent to really put all of his eggs in that basket, hand it over, and not get really any money out of the deal. So I love this topic. I was excited to get on here and talk to Abby about this. So I'm curious to see what we can come up with to kind of put together a playbook for a seller and even a buyer as far as seller financing goes.
Cue Abby Shemesh. As we said, the Lord of Seller Debt. Abby, thank you for coming on the show today. Tell us a little bit about yourself and where the Seller Edge Capital concept kind of came from to help us lead into some data points of how we can help business buyers and sellers get more deals done.
Thank you very much. First of all, I thank you for, inviting me on the podcast. It's a great opportunity to kind of explore this topic, which is, as you guys had mentioned, sorely needed in this space. My journey began years ago, back in the late 90s, early 2000s, when I kind of entered into the origination space. My background primarily was lied within the mortgage origination, residential, kind of moved into commercial. I was introduced to the secondary market, believe it or not, by one of my account reps at Bear Stearns at the time. So that gives you an idea how long ago that was, prior to the Bear Stearns collapse and Lehman, before pre 2008. And I really saw value in the fact that it was just so crowded in the origination space, and I realized that the secondary market, right, not the primary market, but the secondary market, had almost no competition, and we really came into that space, and brought our marketing prowess, I guess you could say, into it, and really kind of ended up where we are today. Amerinote was the family office that I started, which I still operate, and is front and center in that space. And during that period of time, when I had founded Amerinote Exchange, we really saw a tremendous uh, opportunity in the business loan space. And even though the business notes or seller notes were a small percentage of our revenue and our acquisition target, um, I've been operating in that space since at least 2009. Um, and we just never really focused, our primary focus was mortgages. And about a year ago, I was contacted by a group of investors and entrepreneurs that kind of wanted to get the lay of the land. They wanted to, you know, kind of they identified from a distance opportunity in the space, and these were Wall Street folks, these were corporate guys, and I was kind of brought on as a consultant, if you would. And during the course of our interaction, we realized very quickly that we had good ideas, we obviously work well together. Let's go ahead and launch, and that's where Seller Edge and the inception of Seller Edge kind of came into play. And as they say, the rest is history. We've just been kind of heads down, pencils up for the past year, and we are here now and very excited to explore this potential of disruption, because that's really what we're looking to do, is onboard liquidity, provide a straight conduit from, let's just call it, the Wall Street adjacent investor into a Main Street kind of product, and do it in a way that kind of upends and disrupts the industry and allows for potentially a new market to kind of be created, which is the way I see it and my partners see it.
So if I was to boil it down to something real simple,
Yes,
it's a way for seller to get their money quicker if they write a seller note, right? So
absolutely.
the seller means you can write whatever note you write, and we'll maybe get into some of the details of the types of notes you guys want to buy. But
Mhm.
the reality is that seller can get their cash quicker, as opposed to having to live it out. Now, I know that there are plenty of people within the seller space, the baby boomer era, that are trying to maybe create a retirement instrument for themselves when they write that seller note. And maybe those that have
Mhm.
considered the idea of that, they're like thinking, great, I get this annuity, I'm earning interest. Maybe I want them to pay out over 5 to 10 years. But
Mhm.
I think the out of the data that we were able to pull up, Biz Buy Sell, for instance, brought up an article where they asked the question, do you plan to offer seller financing when you exit your business? And they asked this specifically to sellers.
Mhm.
22% of them said yes. 44% said no, which is an interesting thing that we maybe can dive into. But 32%
Absolutely.
were unsure. And I think you got a large audience of people that are not really sure what's going on, don't really understand maybe the strategy that comes along with that seller debt and how to position the notes. Nobody's an attorney. You know what I'm saying? Like that's why you got Brian. Brian can give you some feedback on that a little bit later. But the idea is how do I create this in a way that keeps me protected, that I actually do get paid back by this person who's taken over my business, and this offset of risk for them, I think, is an incredible setup. So I'd love to get into this a little bit. We'll jump straight into some questions. The first on the line is, how does liquidity for seller notes change a seller psychology? and unlock more of that supply. So unlocking that 44%, 32% that don't know what's going on or don't want to get involved. So Abby, in your thoughts.
I mean, I think that it could be an earth-shattering change in the paradigm of thinking, in the same way that, and I don't, maybe I'm not, you know, in the same way, if a new SBA product came on the scene, and it was this, groundbreaking, earth-shattering product that kind of changes the way that people can transact and purchase, that would be incorporated into the repertoire of, say, business brokers, professionals, commercial bankers, and it would be assimilated very quickly. I feel it's the same kind of concept here, and it's really, the onus is on us to kind of provide that reach of education. Because I know you had mentioned, there's 44% that say no. I argue that the 44% that say no are also uneducated to a certain extent. And that's where I think that we can actually grow that. I think that that's just a low hanging fruit answer, based on, a knee jerk reaction. Oh, I don't get my money now. I don't even want to hear about it. Well, Mr. or Mrs. Business Seller, guess what? We can do X, Y, and Z. And I feel like that would capture, and again, I'm just speculating here, but that may capture, you know, uh, 10, 9, 10, 15% of that 44. And we kind of may move that over to the I don't know or the yes category. So that's my argument.
Now, Brian, when we had communicated about we were gonna have this discussion today. Sorry, I'm studying. When we communicated that we were gonna have this discussion today, you said, "Interesting," because I know your mind's thinking about how does this paperwork flow? Like, what
Mhm.
is the how does this contract get set up to a point that it's set up, and delicious enough for Abby's group to even want to acquire it in the first place? What was going through your mind when you heard that, Brian?
Well, the thing that's going through my mind is my background as an attorney is I did some oftentimes due diligence work on selling large pieces of real estate, big office buildings, that sort of thing. And so part of that transaction always involved, okay, we have to go in, if we're buying, we have to go in and look at all the details that go into a contract. So when it comes to a piece of real estate, you have to look at the leases because the leases are essentially kind of like a junk bond, so to speak. You're looking at, are there any potential risks that are going to be in these contracts? I mean, from a seller perspective, what if there was like one or two, maybe three big simple things that a seller would want to make sure that they included or that um, would make their note uh, better, so to speak. I mean, they could maybe capture a little bit more of a premium or something when they're selling that note. What would those be in your mind? Because
Very
that's
simple.
immediately where my mind went.
Yes, very simple. And I'm just going to blurt them out. No offset language or very little offset language in the contracts, both in the asset purchase agreement or the promissory note. Personal guarantee, if it's an entity, obviously, if it's an individual, it's built in. And number three, language in the asset purchase agreement or promissory note that allows the seller to request anywhere between 1 and 4 times a year, preferably 2 to 4 times a year, financials of the borrower to make sure that the borrower slash buyer is not running the business into the ground. Those are the three immediate things. And then we can talk about, you had mentioned leases. That also comes into play too. It can get a little bit more nuanced, but just to kind of touch on what you said about leases is if we see a deal and it's, let's say, not a new deal, right? So this has happened, in real life here. So we see a deal, we see that the lease, let's say the loan is a 60-month amortization, fully amortized, and it's 8 months in, 10 months in. But what they forgot to do or failed to do is there is a lease expiring in the next 4 months, and we're looking at that. We're saying, okay, well, let's say that there's no renewal on that lease, right? For whatever reason, there usually is, but let's just say there isn't. Um, we're going to have thoughts about that in the underwriting process, right? Because that could significantly interfere with our monthly, with collecting that payment. Is if especially if it's a brick and mortar business, if they have nowhere to kind of set up shop, I'm not saying it's a dead deal, but we're definitely going to want to dig in, double click on that, maybe speak to the landlord or communicate with the current landlord, which is tough because if there's no language in the contract compelling the buyer to do that, it's really like, and we get it done, but it's tough, so let inserting language that makes the offboarding or the off ramp uh, a more seamless transaction, and you're not going through, a gravel road, so to speak, when you're trying to do that. Something
Hmm.
nice and paved and smooth, and that's ideal.
Yeah. Just a quick follow up. Uh, what are offset rights? I
So,
guess.
in a nutshell, I'm just going to use very simple terms. The seller, you know, originated accounts and vendors. Let's say they have, outstanding vendor bills due or accounts due, and the business is sold to the new buyer, and the seller either failed to or forgot to or wasn't privy to some sort of monies being owed to previous vendors. The seller gets their cash, they go on their way, and then 6 months into the ownership of the new buyer, someone comes knocking on the door and say, hey, the guy who used to own this owes me 20 grand. Well, if you have a right to offset and you have to pay that 20 grand, in some extreme cases, you could just not, okay, I'm paying you $5,000 a month, Mr. Seller. So I'm not going to pay you for 4 months because I just paid 20 grand that you owed.
Mm.
Now, that's it from an underwriting perspective, that's a non-performing loan, offset or not. That is a deal killer, plain and
Yeah.
simple. So you want to make sure if there's language, you have to put an offset, put an expiration on it. We can only, 6 months in, after 6 months, it's on you. Or if there's an offset, someone comes knocking, that not only is there an expiration, but the seller has to step up and pay.
Mm.
And if not, and if there's an argument, legal or otherwise, then the buyer can exercise their right to, um, quote, miss those payments in order to point that cash to the vendor or the offset that they need to pay.
Interesting.
Yes. So that, a lot of most people, I mean, people that have been in the industry for years aren't even aware of these. They know of an offset, especially the business brokers, right? They know of an offset. Once the business is sold, they may get involved, they may get a phone call down the road, but typically not. I mean, they're already,
Yeah.
working on their next 4 deals.
Yeah.
Hey, you
Exactly.
bring up an interesting point. Steph, I got a question for you. How many sellers and buyers have you encountered that have actually thought that thoroughly through? I'm trying to
Or pretty good question. How many lenders have actually thought that through?
N
I mean,
Nail on the head.
like you
shooting
just
this
said,
deep.
Abby.
I'm like,
Well,
you're
and that,
you're just
listen,
flipping
I'm
out
listening
something
to
from
you guys.
ChatGPT.
Yeah, I'm listening to you all talk, and I can't tell if I like this or I don't like this. And I'm s- I'm trying to find the nugget. All right,
Mm.
and the reason being is like, why would I want to buy some mediocre's banks? But the bank's not involved, so it's some mediocre seller buyer transaction that was poorly executed in some rural area with two mediocre attorneys, more than likely, right?
Or
Or,
no, it's already.
or
Or no attorney.
I'm thinking to myself, how do I just be the first one at the dance? And so, how do we just provide an alternative to financing without the seller and just go straight to market? Like, have
Ah,
you thought about that? I don't know. Explain what the product is. Tell me what the product. Like, what are the terms in your favor? Because if I'm you, Abby, I'm thinking to myself, man, I'm buying this portfolio of assets that are in Dubuque, Iowa, or wherever in America that I'm gonna have to manage. And oh man, the guy's not making his payment. It could be a servicing nightmare, you know?
Mhm.
If because you're buying seller notes, so there's a lot of due diligence that you need to do on your end, right? You're basically
Mhm.
underwriting the deal.
Mhm.
Um, or do you just go straight to market? I don't know. Have you thought about it? Talk me through your current product.
Sure. So when I will absolutely. I just have a question. When you say straight to market, I know it obviously what you mean. That could mean several things. Can you elaborate a little bit on that?
Alternative financing for small business owners.
Gotcha.
Like, right up
So
front, right?
right up front.
Yeah.
So
Through the family office,
um yes, and that's that. I mean, of course, our it yes, to answer your question, our thought process here is um there are thousands of these types of assets, probably tens of thousands or more of these types of assets that are just kind of collecting dust in a desk drawer. And when we, from in my experience, you're right. There is mediocre assets or mediocre attorneys drafting mediocre loans that don't necessarily look great and wouldn't be the best loan product, so to speak. But to be quite frank, if the price is right and you have the ability to kind of provide that, situation where you're providing a debt-free lump sum of capital to the seller and then providing support for a buyer, we like to see value, not like to, we see value in all types of assets, right? And then that's really, kind of our thought process there. So yes, right now we are purchasing existing business loans. We have an answer kind of to your point of how do we further tighten up that box, right? That to make sure that the language in the note, the language in the asset purchase agreement, the language in the security agreement, and the personal guarantee really, knock our socks off. And we have that in the works right now, which we plan on rolling out in the next 6 months. But as far as specialized lending products, that we've I can't say that we've put too much thought into that because there you have the SBA. I mean, the SBA. Let's be honest. They have uh, subsidized money, right? They get their money more or less subsidized from. It's not like Fannie or Freddie where it's like the U.S. taxpayer, but their pockets are deep, and their pockets are deep because it's a forgive me if I'm not accurately representing this, but a quasi government entity, and that's not saying hard, impossible, but definitely there's already fish in that sea, right? We want to kind of go and see an area that requires an answer that no one's solving, and we feel that's the seller note space. I'm not suggesting, Steph, for 1 second that what you're describing can't be lucrative. I'm sure it can, especially if you guys are doing it. But I will tell you that that our cup of tea is the seller note space.
Well, so maybe I have some thoughts on that too. I was thinking about it a lot over the weekend, especially, and since we had talked there in Raleigh,
Mhm.
the there's some strength in seasoning. Right? Like, so you've been in a market where you've been doing this for years, buying existing notes that have already been written, already had some level of seasoning, and you essentially go in and you're buying them at a discount. So for every dollar of loan amount out there, maybe you're paying 80 cents on the dollar to get the note in underneath your management, and you have some built-in value from day one. So you've already got built-in return day one, similar to how a lender in the SBA space would take their loan and sell it on the secondary market and make their return day one. Like, everyone wants that built-in value day one. Otherwise, you're just hoping and praying at the time of close that that buyer actually makes the payments. So I think that there's the two strategies here, and correct me if I'm wrong, Abby, is that the you get your day one asset value. It's like buying a piece of real estate for 80 cents on the dollar, knowing that it's worth $1 million, right?
Mhm.
But
Yes,
there's also the idea that at least that buyer has already kind of gone through some of the transition pains, right? Like, when that's
that's
one of
right.
the risks is as a buyer takes over a business, there is plenty that's going to fall apart in that first 6 to 12 months. That if you can come in after that mess is already settled and we can show that guy's made 12 months of payments, then, like, yeah, I want to be in bed on that note, as opposed to just hoping and praying that the guy actually knows what the hell he's doing. So Different strategy.
And I also want to add too, you had mentioned, and I've just about, that's a great point, Shane. That's exactly right, for sure. But you say, why not, bring an alternative financial product? I find, Steph, that the biggest issue is capital market dislocation. Especially with family offices, right? So most family offices require a return of 18%. That's a hell of a lot more than a 10% on NSBA. What do you? I mean, so that would be my first, like, to actually give it some like high level thought. Now, I'm not suggesting for 1 second that that can't be solved, but it's going to require a lot of acrobatics, and that's fine. That's what we do, right? But this is a more like as Shane said, there is a built-in mechanism here that we feel confident to kind of roll into and step into the shoes of an existing deal that has a track record. Um, and that's where our desire to want to improve the market lies at the moment.
I mean, I love it. I love, you know, portfolio management is really the space when when you think about it. It's portfolio management. And Shane, to your point about seasonality, um, it peaks, right? So when the average business default happens in age 5, 6. So there's a
Mhm.
sweet spot there. You need to get in and almost get out as fast as you can because after year 6, the likelihood of restaurant, you know, s- Mike's sub shop staying in business, it's a diminishing rate of return at that point. So are you
That's
providing
right.
short-term debt here, Abby, on these?
Yeah. So when you say short-term debt, so are you meaning our investment appetite and our horizon?
So that
It-
seller note, when you're taking it out and you're
mhm.
providing the consumer or the borrower a note, what's the term of that note?
So the term typically, I mean, that's really going to be dependent. And so there's two answers to that question within the phases of seller edge capital. And seller edge capitals, I guess if you want to say in phase one, I mean, where we're actually looking at all existing loans and then we're finding the best fit, typically speaking. And this is not just for seller edge. This is for the business note buying world and has been for, the past 20, almost 20 years that I've been operating in it. Ideally, most investors, both private and institutional, typically like to be in and out of an investment within the first 3 to 5 years.
Yeah.
It perfectly aligns with what you're describing. Now, do we see loans that have a 10-year amortization? Or, I mean, I got one right now that has a 240-month amortization on a business. So you want to talk about poor quality decision making, and there's multiple attorneys on that one. So so yes, we see all flavors, but 3 to 5 years ideally. We may be able to go out to 6 if all the stars align.
Yeah, that makes sense. You want to get in and
Hmm.
out because then they start
That's
to
right.
go sour.
That's right.
So what you just
And
identified the type of note that you're looking for, essentially. So when a seller's writing something, you don't want are you saying you don't want the amortization or the period of payback that the monthly payment is based off of to be past 6 years? Or what in the case where it's 240-month amortization, you figure that front loaded interest, that first 3 if has a balloon attached to it, like that payment that it's due in 5 years, that's pretty much all interest. So
it's all interest.
dollar is going towards someone making a pretty sexy return on when all is said and done, so
Yeah, and just to give you an idea, when we talk about purchasing seller notes, there's 4 ways that we purchase seller notes. So there's 2 verticals, and then within each vertical, there's two purchase options. So we can buy the entire loan, which is referred to as a full purchase offer. And this is not a unique to Seller Edge. That's actually been around since the 70s, the Eric Carter era, when interest rates were 13, 15, 18%, whatever they were pre, before my time. I'm assuming everyone's time here. Um, and so seller financing became a huge role. And then the secondary market, the discounted note market back then, would either buy a full purchase, which is all payments remaining, or a partial purchase, meaning a portion of the payment stream, and they would back into their equity, they would back into their risk exposure. And let's say, so if on this 240-month amortization, if we are to take a swing at it, we would only be able to probably take a bite-sized portion of that, referred to as a partial purchase. Maybe we would take a look at 3 to 5 years of payments. But a lot of the sellers, especially on a loan term like that, would say, you know, yay, this is good. Or, some of them will say, hey, this is not even close to the capital I need. And that's just something we just can't transact on unless they modify the loan. And we actually have one right now where they're in the process of modifying the loan to kind of fit a better need. So the brokers working with the seller to work with the borrower to shorten the loan term. And there's ways to compel the borrower to do that. And they're working on that as we speak.
That's
Yeah,
awesome.
there's so many ways to carve this up. I
That's
think
right.
of the solution because you just brought something up. Okay, I'm Mr. Seller. I have this seller
Mhm.
note that I just sold my business, and maybe I'm only gonna sell half of that. So the
It's yes,
liquidity of it, going
it's
back to that
fractional.
element, I still want some of it, but I need 500 grand of my $1,000,000 today. So there's a way to still exit some of it in the event that the terms were set up right, and I think that's the key component, is
Cor-
create an environment, creating a knowledge base for people that's simple enough for a seller to have that from day one. So when they start
mhm.
considering to sell their business, and I think that's why we met Abby at a broker convention, a business the Carolina and Virginia Business Broker Association convention. And it's a great environment because these business brokers are out there representing sellers left and right. It's
Mhm.
imperative for these guys to understand that this tool is available. That when they're framing up the transaction for sale, and before negotiations even begin, that seller knows under what terms it makes sense based off of whatever their long-term wealth strategy is post-sale. So,
That's right.
what kind of elements, I mean, what kind of education, or is there anything that you're putting out there that is to help a small business seller to know what the hell to do? Because I'm all I can think of is, like, with all the language we banker people use and note buyers and everything else, I'm sure they're thinking, "What is this? What's really the end point?" That gets me to an idea that says, "Yes, this is something I can use tomorrow."
So you're saying direct to seller education.
Exactly.
Gotcha. So direct to seller education is going to be it's going to be an awareness campaign, if you would, and how that's going to be carried out is it's going to be carried out primarily, I would imagine, online. I say I imagine because we're kind of still working through it, um, but it would be primarily carried out online. There's going to be some elements that are going to be carried out offline. It's going to depend on, we have multiple strategies to use. I mean, there's a ton of different strategies we can use, but the question really is that, I'm of the mind right now where it's more effective to educate the broker and let the broker educate the seller, just because the broker already has reach. Now, I'm very familiar with the market trends on, let's just say, search engine optimization and AI is kind of a new thing that we're kind of exploring, but there are very few sellers that even know this exists.
Yeah.
So to rely on them to actually have a searchable term and then have you be there to answer that query, we may be waiting until the cows come home because they just don't know. So we have to be proactive and perform outreach to professionals that are already speaking to the sellers uh, via events like the one that we met at last week. Maybe lunch and learns. Again, that's something that is a little bit more intricate, and I say it because it's the most common in a lot of spaces. But we there is an education piece here, and right now that education piece is going to be geared towards brokers. That's going to be geared towards sellers, financial planners, exit strategy folks in
Yeah.
the business selling world, which is some of the great conversations we had with some of the companies that were there. It's going to be a plethora and a different combination of things that we're going to need to orchestrate, and that's the way we see it. And to be honest, our we've had a very good response so far, and we know that there's a market here that requires maybe some shaping a little bit, forming and support. But once we get that, we should be able to kind of, you know, get tons of lift.
Well, I think about,
Accountant. I
You need
think
Seller Edge podcast. I mean, just create it, damn it. I mean, it's tough. Call it
That's right. A podcast.
podcast, right? I mean, because I kid you not, it fits flawlessly, and it's an angle that I don't see many people. Everyone's living on the origination side, right? Like most
Yes.
of the noise that exists lives on the buyer side. That's where the debt is. That's where the borrower is. That's a long-term relationship that perpetuates. Granted, there are plenty of wealth management guys that live on the seller side that are marketing to those guys to figure out what the heck to help them do with their money. And like you said, those are some of your referral partners, if you will, in orchestrating some of that. But Brian, I'm curious your thoughts on this. And I think again, going back to the paperwork transfer, like some of the risk, in my mind, Seller Edge has a templated packet of seller notes. Like, here's an example of what we want to buy. Fill in the blanks.
Mm-hmm. Mm-hmm.
Is there a risk, Brian, in using that? Because obviously these guys aren't attorneys, but you can create this as this is what I want to buy. Here's your buy sheet, and I want 6 months after you've written that, just start throwing that leaflet out of the flipping plane at every seller convention that exists, and let it just land on people, and let them see that, hey, I have the chance to get out of this. Sure, I just need to frame up my paperwork so that they actually want to buy the note. So
Yeah.
where does that go
Yeah.
wrong if they do that, Brian?
Well, I think it goes back to some of the things we talked about at the beginning, right? Some of those, the offsite right, personal guarantee audit rights, some of those key factors you're looking at in transactions. And then I also think the size of the transaction dictates some of the risk that you're going to see. I mean, on those smaller deals, you're going to have mom and pops that have no idea what a lot of this stuff is. And so there actually might be some, like you were saying, Abby, some ability to go back and say, hey, seller, if you want to sell this, we need the buyer to be on board to modify that note. And
Mm-hmm.
if not, yeah, we can. I don't know if we have a deal. I think
That's right.
it seems like the larger transactions probably necessitate a little bit more hand holding from a legal standpoint. Like you're going to have someone in there looking at things because obviously you don't want to take a big loss. But to
Mm-hmm.
some degree, I think that you could mitigate that risk by just having some sort of templated format in what you're looking for. Hey, we need to see these 6 things in in your seller note. If you have them, great, boom, let's go. And then that's going to make up a small portion of the transaction you do. And then from there, you kind of decide, okay, how much of these other ones that don't fit that cookie cutter box do we want to play with?
Yes, and then that is in the works. The templated package that is in the works that we are currently rolling out, and that's so. As I mentioned previously, as we're buying existing, a lot of people ask, "Hey, do we need to get your docs and then create the loan and then wait 6 months and then you buy it?" And the answer is no. We can buy what's out there now, but as we continue our upward trend, we're going to start dialing that in. And like I said, the process has already begun where we'll get legal on board and provide that. But you are correct. I would say in the larger transactions, I mean, we've seen some really interesting stuff that we couldn't transact on for whatever reason. One comes to mind. It was a satellite company that they were a commander from Space Force was the CEO. He's brought on, and it was a $17 million first, and it did pay down quickly. So, and it was very low interest. So that was also tough too, because that kind the delta for the discount becomes much greater when you have a 3.5% interest rate. Your target yield is well above that. So um, but there are very interesting and complicated businesses that are probably north of the 10 million range, maybe even not, maybe slightly south, but in that range that you're going to find a lot of moving parts, and it's not going to be a one size fits all. But we do find that there's going to be a lot of value add to the, very least. The $100,000 range unpaid principal balance up to the million for sure. I would say even up to the 2.5 or 3 million for sure. I do know SBA operates. That's the space in which SBA operates is that 500,000 to 5 million. But that doesn't mean, I mean, a lot of the loans that we're seeing are also in that range. And for whatever reason or another, they didn't use SBA because they wanted velocity on the timeline, or the borrowers, couldn't come up with the 10%, or they didn't want the 10% interest or whatever it was. We see a lot of them with 20, 25% down and a 5% rate. And, I hear this story constantly where it's, hey, we wanted to get the deal done quickly. I don't mind seller financing. I don't necessarily need the money. The down payment was enough.
Mhm.
But now I need the money. That's why I'm talking to you. That was a year ago, and now I need the money.
Yeah. I would say, if I could just jump in real quick, I would say, to wrap this up in a nice bow, I want to think about what synergies exist between your firm and our firm. And the synergies are, of course, any SBA business sent our way, right? But I can't tell you how many times, me personally, I've been in the niche vertical business, right? So I am in specialized industries, and I go in there and own that niche industry. And my referral partners are accountants, attorneys, business brokers, all the guys that you probably are going to want to target also, because they're the ones structuring the deal, helping the seller get out, helping the buyer get in. SBA is a great alternative if you have time and energy and working with a trusted partner like us that can get you across the finish line. Believe it or not, there are a lot of SBA lenders in this country that fumble for months, and they'll fumble that ball for months and drag everyone through the mud. And guess what? At the end, the seller and buyer are like, forget it. We just want this transaction to happen. We're going to do seller financing. Bye, Bank of America. We don't want your help anymore. All right. We'll see you later. And what their thought process is, let's just do seller financing, and then we'll continue this year-long path with the bank and refinance that note. Well, it still doesn't make the process easier. All of a sudden, they don't just rub the Buddha and the process is fun. It's still terrible. So they are looking for ways out. And that's why we can flip a lot to you. Because that's that deal that I lost because they went seller finance. They don't want to deal with the bank anymore because they realize, you know what? We're just going to hang on as long as we could possibly hang on and just pay the seller. But the seller wants out. I mean, these baby boomers, they want out, right? So that we're going to flip a lot of business to you. And hopefully you can flip a lot of business to us on the front end with the SBA loans that don't fit your model, but that you're stumbling across, because we're calling on the same people now.
That's true.
I yeah, could agree more. And first thing, really, the lowest hanging fruit comes to mind is refi takeouts. We have borrowers that are balloons coming up. Now we hand you a borrower that has 52 months of pay season, pay history. That's a service pay history. Now I mean, I don't want to pretend to know because I'm not an SBA commercial lender, but when you guys are underwriting these things, right? So you're looking at cash flow of the business. You're probably looking at borrower or guarantor credit score, how they pay their bills. But if there's if you have pay history on the actual business that you're going to be financing, I would imagine that would be very powerful.
Oh yeah.
Yeah. In fact, you're required to have 2 years of pay history of a seller note before we can even touch it. So even if you came in and bought a note 6 months after it was originated on seller edge
Mm.
side, we couldn't
Mhm.
touch it for another 18 months. We need to see 24
Mhm.
months worth of payments, because the original debt that we'd be paying off, even though it's you now as the owner of that note, was a
Mhm.
seller finance note. So that
Mm.
seasoning still needs to happen, and obviously that helps somewhat of the balance decrease and everything else. But once
Mhm.
that 2-year period has crossed, from when that origination happened, enter SBA, right? So which also creates an interesting opportunity for yourself. So now if you know you've got an exit on the tailor end of that in 18 months, you can write your acquisition terms of that seller note in a way that allows you to know that your investor is going to get this much return by the end of that period. So that you
Mhm.
start priming the pumps. I mean, you've already working with that buyer, you've created a relationship for them. You also get their mind set on the idea that they have this nice, pretty SBA exit that has a 10-year term, and we just frame it up. You can literally log it in the calendar. I know this guy's
Mm.
coming up 3 months ahead of time. We start helping him put together the paperwork, hand him off, and the SBA guys execute so that you have your exit right on the back end of it. Granted, maybe you want the return, but I can imagine for those notes that have the 3, 5, 6% return, like interest rates, maybe that's not the most sexy to keep on in your assets under management. You want
Mhm.
instead that execution to get the balance reduction return already like on your table. I think that's your exit. That's a pretty role that I think we can fit into. That's kind of what you're thinking, right,
Absolutely.
Steph? Yes? Did I
What's that?
cut
I
you
didn't
off?
hear you. Your hands in front of your mouth, Shane.
My hands in front. You haven't heard anything I've said because I've been doing this
Nope,
the whole
I
time.
heard all of it from your hand.
Okay.
What?
I do this. It's my thinking thing. You know what I mean? Absence
You
of
like this?
What was that
hatred.
last bit? What was your last bit? What was the question?
I don't even remember. You just
Ah,
derailed me with the whole mustache and beard thing. But we're gonna go off that. It's all staying in, by the way. We're not cutting any of this. But okay, so if you're listening to this and you're a buyer or a seller or a broker, you just heard a roadmap to closing more deals, and that used to be, I would say the ones that used to be a little bit more impossible. So seller's edge isn't really, it's not a theory, it's a live weapon in the acquisition game that you are all playing in, and that we're all playing in. So sellers, you got to stop thinking that you have to be the bank forever on these notes. The buyers on this, stop letting deals die just because you can't bridge at least that 20% gap. And for any brokers, this is your magic wand to resurrect dead deals and increase more of those close rates, those sellers that couldn't quite figure out a way to strike the deal off what was offered to them. So the age of dusty seller notes is over and the marketplace for liquidity has arrived. And if you're not paying attention, you're going to miss the renaissance of Main Street that Abby and his team are putting together for us. So, Abby, thank you for stepping into the chamber with us today. And to our listeners, remember your business, your capital, your legacy. Don't just play the game, master it.